Patrick, back to you. You identify yourself to me when we met first as an active investor. What's the journey of active investor towards smart beta?
It's an interesting journey for Rosenberg. So I briefly alluded to the genesis of the firm. So a gentleman by the name of Bar Rosenberg, who's a professor at UC Berkeley in California, had been doing a lot of work around attribution, risk modeling, optimization, portfolio construction, and attributing returns, factor returns, betas, different type of characteristics in the 70s, developed a firm called Barra Analytics, which was eventually purchased by MSCI. So you can think about the standard attribution package that a lot of portfolio managers would use to deconstruct the drivers of the performance in their portfolios. Is there a tilt to value? Is there a tilt to small cap? What kind of industry contributions do you have? Sort of things that we today take for granted in understanding performance in portfolios. Bar Rosenberg was the genesis of many of those ideas. So the firm has had a very deep and broad understanding of risk factors and portfolio construction. And as we've evolved over the last, say, 15 years or so, I think what's become clear in the marketplace is as these ideas have become more commonplace, and as the technology has improved, and the academic literature around some of these factors have been more widely distributed, whether it's the Fama and French work or other work that's been going on since the 90s, those ideas have become imbued in many portfolio managers' sort of their toolkit to put a portfolio together. And what we found today is that you can very cheaply, transparently, pretty easily put together a portfolio that has a tilt to value, that has a tilt to small cap. And I think if you go back 15 years ago, there were many, many active managers in the marketplace who were doing the very same thing, but charging active fees for this. Today, there's much more transparency. These tools are much more available. True alpha, in a sense of not driven by alpha that's orthogonal or totally different from these factors or industry contributions, that's much rarer today. And so I think what the evolution has been is that it's pretty clear to me and to us that you're gonna have to do a lot better as an active manager outside of just targeting well-known risk premia in order to generate fees that in the past were 2 or 3 times what you would have to pay for a smart beta strategy today.
Okay, John, how does Cathay Private Bank use smart beta or factor investing for their clients?
I think whenever you talk about ETF or factor or smart beta products, it is being used, but it's not being used very widely. And I think the revenue dynamic, I think many of the people sitting down there knows better than myself. Comparing an ETF product and a mutual fund product here in Taiwan, mutual fund product, you get upfront fees and you get trailer fees. So the revenue dynamic is a whole lot better than ETF. So that would actually tilt from a distributor's perspective which product that I would advise my client to actually use to express a investment view in his or her portfolio. So what we typically do is when we engage a client, perform the KYC, make sure there's no investment suitability issues, we actually advise that person to deploy mutual fund products to express strong conviction in the medium and long term. And then we try to capture some short-term trading opportunity with single stock equity or ETF-like products. So this is how it is being used. The experience has actually been mixed because currently in Taiwan space, a lot of ETF products, especially with these kind of views embedded in the design, we like it a lot, but there simply isn't enough liquidity to make sure that we will put that we're comfortable enough to put that product on our investment advisory list. So I think that's something that the industry needs to overcome before this product would become more widely accepted at the client level.
Okay. Add something to John's comments. I mean, I think it's the critical analysis with smart beta or factor investing is that these are long-term ideas. These are not, in my opinion, they're not tactical trading ideas. You look at value, you look at quality, you look at momentum, you look at low volatility, just to name 4 of the more common factors and sort of smart beta formulas that are used in the marketplace. These have long-term positive means, and you need to be exposed to them over a long period of time in order to benefit from these trends. to have a 1-year time horizon for a smart beta strategy, I think is just going to set yourself up for disappointment potentially. And so I think one of the constructs you have to keep in mind is that these smart beta ideas, risk premia, factor investing, whatever you want to call it, it works, but it works over the long time. And it's tough to tactically trade these ideas.